All right, fantastic. Episode 4 of the new Investor Circle series sees us with Ollie from Resonance. Thank you so much for being here, my friend. Lovely
Pleasure.
to have you here. And all the way from sunny Bristol today, right?
It's sunny Bristol, exactly.
Wonderful.
Where the sun never stops shining.
Now, we know each other through a couple of different raises and a couple of different formats. So it's wonderful to have you here. And I know everything's changing for you guys at Resonance at the moment. So when I ask you this question, what's the thesis of the fund? I guess you're going to have to tell the full story, right? So what's it all about?
Yeah, great. Thank you. Well, look, Resonance has been a social impact investor in the UK for a long time. We've been 8 years of running funds investing into growth stage social enterprises. We are just at a really interesting point in time where we've finished deploying and gone into the sort of fully deployed phase of 3 funds, and we are starting a new mandate, launching a new mandate from September, which encapsulates kind of all of the, we think, hopefully the best bits of those experiences we've brought, and some new ones. So in headline terms, we are beginning our journey as what's called a CDFI, a Community Development Finance Institution. This is a accreditation from BEIS, in fact, which allows us to, amongst other things, it allows us to give investors access to the community investment tax relief, a little bit like an EIS tax relief or an SITR as it was, social investment tax relief, but slightly different. So firstly, the structure is a CDFI. CDFIs are well known in the US, less so and operate at lesser scale in the UK, but heading in the right direction. The mandate still is to provide growth stage capital to social enterprises in regions where we're specialists. So at the moment, we're focused on the southwest of England, the West Midlands, and the northwest of England. Those are regions where we're based geographically. We have teams, we are on the ground. We will be there alongside our entrepreneurs, having coffees, not phoning or traveling from London or further. We continue to focus on social impact first, financial sustainability and profitability alongside that. We have historically had a fairly strong vision that a social enterprise has a certain set of sort of statutory features. So we do believe in community interest companies as a legal structure. It's a UK-based sort of legal structure for social enterprises. We still want to invest predominantly in KICs, CICs. We also invest in charities with trading operations. And we are now, for the first time, also investing into companies limited by shares with mission.
Ollie, you've just gone on mute, mate. It's really weird. All the sounds just cut out. I don't know if the cables come out or...
I find
that's
Skype
it. You're
so back.
Yes, I don't know what that was. Don't worry, I'll edit that one out. Or we'll just leave it in for fun. If you're watching this and you've just seen that, that's all good.
Yeah, what we don't do is tech investing, as you can tell. Where was I in that rambling? So yeah, we continue to invest in social enterprises. We continue to invest into KICs, predominantly in charities, but we are also investing into companies limited by shares where they have what we consider to be like structural features of social enterprises. You know, those are quite, we find a lot of entrepreneurs who are not used to social enterprises as a structure would say they're quite limiting. A dividend cap, for example, who's that serving? They're all kind of fundamentally about long-term commitment to mission and recycling capital and not allowing the sort of hunt for profit to outweigh the hunt for impact.
Okay.
You know, it's an argument whether they're successful, whether they could the whole story or not. I just have one last quick thing. We are focused on 3 areas of what we call impact. So it's socioeconomic inequality, health and wellbeing outcomes, and for the first time, a just transition to net zero. So this, you know, they're all kind of social in a sense. None of them are explicitly environmental or health. They're all linked in, but they are as wide a spectrum as you can get, really, of what we consider social and environmental impacts. That said, that means very clearly we're not like a green tech investor. We need to know that the reason you're involved in, let's say, green tech is because you're wanting to look at that from a inequality and social justice kind of perspective. So access to green jobs definitely would be a part of the just transition. green jobs per se, perhaps not.
Okay, so first question, equity, debt, how does this model work?
Great, yeah, good question. So historically, we've been, as has been the case for most UK social impact investors, using unsecured loans to provide growth capital to social enterprises. The reasons for that being that largely that's all that they could take. Charities can't issue can't issue equity. CICs, if they're companies into a guarantee, also can't issue equity. But some CICs that are companies into our shares, and obviously companies into our shares can do equity. So the movement over time has been towards wanting to do more like equity. So we actually do 3 different products. We do unsecured loans within this fund. We do revenue share, which is essentially a debt structure, but the returns are not interest coupons. They are revenue shares beyond a certain point of revenue growth. And we do some pure equity for a very small amount. Now that pure equity obviously is in the case, is still to enterprises that are asset locked, for example. So a CIC with a company into by shares. The reasons you'd invest in equity in that company are quite different, I guess, to sort of a Series A looking to exit. So it's all 3 things. It's unsecured loans, it's a revenue share as a quasi equity product, and a small amount, we're thinking 5% of the fund is in actual equity.
Okay, so I've got 2 threads from this one, which I think is incredibly interesting for people because it's so different to the sort of VC and other routes that we normally look at. So first thing, whenever I'm talking about resonance with people, the first thing people say to me is, but social enterprise doesn't make any money. So why would I invest into that kind of thing when I can't possibly expect anything really more than my money back, right? What sort of return am I going to get? So how does that work? Does social enterprise make money? Is it worth doing this?
Yeah. Well, look, it's an important an interesting question, because it's fair to say, I think, if you were to be able to look at all of the data, social enterprises do distribute less profits and perhaps make slightly lower profits potentially. But actually, I think what you see is that they are sustainable in a different kind of way. So they are potentially some ways counter-cyclical. If you think about the demand for their services and their products, often
it goes up when the economy goes down, right?
Yeah. So there's that element to it. I think if you think in traditional terms of exits, it is difficult to picture that you can make money out of these because, you know, what is an asset lock? By its very nature, it's something trying to stop you being able to sell this for its constituent parts or to sell it full stop. So there's a lot of protections that make a lot of the traditional ways of capturing value for investors, they're not present. And I think what we look at is the time scale over which you're willing to invest and the amount of impact you get delivered as well. So I think my simple answer is yes, it's clearly less obvious that you're going to make a lot of money out of investing into social enterprises. I think there are some structural reasons for that, but there are also some reasons of time horizons that we might look at the business models of social enterprises if we're being honest about what matters. And then there's the idea that you get impact returns, you know, and when we say we're an impact investor, we are talking about tangible, measurable, monitored impact delivered through these business models. So we'd like to think that whilst you may expect as an investor in these a lower return, or let's say a steadier return for a different time period, you're also going to receive real impact metrics around what's being achieved for that investment.
Okay, so it should be something you care about, basically, something that you want to see different in the world.
Yes, and also I think it's about accepting that the timescales over which an IRR makes sense are going to be slightly different to the timescales over which an impact and a sort of slower rate of sustainable profit might make sense. It's certainly difficult to fit it into a typical limited partners thinking that the returns might come after 10 years, even financial, when we all know the IRR is heavily influenced by the cash flows up front. So it's trying to let the weight of impact and the importance of impact within the model kind of rebalance some of the financial preferences, not necessarily to make money, but to when to make the money and how much is sort of necessary.
Okay. Now the other question is usually everybody really that I deal with knows what SEIS and EIS is when we're talking about investment, but the kind of what was the social impact tax relief or what it is now the community stuff, how does that work? Is it very similar to SEIS?
Yes. Well, so social investment tax relief as of April this year is no more. It was very similar to EIS and was designed to be so, which was in some ways its strength, but in other ways its weakness. Social investment tax relief is gone, so in some sense, let's not dwell on it. It looked a lot like EIS, but it was available to use for social enterprises and on debt, where EIS was largely equity. Community investment tax relief is a bit different in that it's a tax relief available to investors for investing into a CDFI, an accredited CDFI. SITR, like EIS, was for the investment into the underlying investee, the organisation. You might have a manager as an advisor to the fund, but ultimately you're directly investing into the organisation. CITR, community investment tax relief, you're entitled to that at the point you invest into the CDFI. So the CDFI then goes out and does the investing, creates a portfolio, creates the returns, pays them back to you. But the relief is for being an investor in the structure that is the fund. The relief is 25%. The relief is paid out 5% per year for 5 years off of either income tax or corporate tax. So interestingly, it has the ability to be a tax relief used by companies with an income tax bill.
Interesting. So, but 5% every year for 5 years, rather than getting that relief in the first year that you do the investment, basically, which is how the SCIS works. Yeah. Okay, interesting. So, I mean, Ollie, you're obviously very good at this stuff. You've been doing this for a few years, but what's the background that you have that makes you awesome at this? You know, did you read classics at university, or what you know, what is it that's you?
I'd love to feel like I'm awesome at this every day. Look, I studied economics and international development at university, and was very much interested in the world of development, and I'd lived most of my life in developing countries, as we termed it then. I then went and worked for an investment bank because I had some student loans, and I thought, this sounds exciting, and capital markets are fantastically interesting. And I spent 10 years working for an investment bank through the financial crisis, and was, fascinated and horrified by how the financial markets responded and coped, and what was thrown at them afterwards to try and keep them going, and just had this kind of underlying feeling of there's a financial economy and then there's a real economy, and I can see one of them is really suffering, but the financial economy seems to have been continued in some ways, not unaffected, but that was quite an interesting experience. So that began a journey of kind of getting to know a bit about the fact that social investment and impact investment existed back in 2015. I went and lived. I finished working in banking. I quit and worked in Sri Lanka for 1.5 years on a tea plantation on a project to bring a sort of an impact tourism project to life, which was fascinating and gave me huge perspective. And then I came back and did an MBA. I got to know Resonance actually already. I did a small project for them, and then I went and did my MBA at Oxford Business School. Again, great privilege, really interesting, mostly interesting in terms of how much focus there was on the changing reality of what business needs to contribute and what investment needs to contribute to the world and its problems. And that is kind of how the school set themselves up as a business school, to kind of solve for those problems rather than making great business people or consultants, bankers, etc. And then I've returned to Resonance, and I've spent the last 4 years at Resonance working on our growing enterprise funds and our overall kind of strategic vision of how we make finance a force for good and bridge between investors and social enterprise and charities. Which the UK is a fascinating place to do it. Typically is held out to be, or talked about often as being sort of quite ahead of the game on social investment. I think the truth is that there's a lot of central efforts have gone in, policy work, Big Society Capital's existence, the Access Foundation. There's a lot of work's gone on around government putting the frameworks in place to make social investment a thing, from the Social Investment Task Force, from Sir Ronald Cohen. There's a big movement here. I think that there are other parts of the world, regions of the world now, that have really caught up using perhaps more market mechanisms, more investor initiated impact drive. So I still think it's an almost impossible task to make money inherently do things for moral reasons. But I think that's not necessarily
take on it.
Yes, it's not necessarily what you're trying to do. You're trying to align all of the outcomes with a financial, if you need to. The environment has been the great catalyst of this, because I think it's been much easier for people to picture the idea that climate change and environmental degradation is an externality that we have needed to bring in to the picture, and that matters on companies' balance sheets. It matters on investors' balance sheets. So that journey has helped catalyze a lot more work around, well, all impacts negative as well as positive, should be recorded and part of businesses' modes of operating, and for investors as well. The logic behind how can pension funds exist with only a fiduciary responsibility when the times after which they're going to expect their returns for most pension holders, we could have already had catastrophic climate change. And you sort of think, when you look at it in those terms, it's obvious that as the stewards of people's pensions, there's a lot more at stake than purely the amount of money they have in that pot at retirement. But it's been a fascinating time to be on this journey, but it does constantly feel like there's a lot more to do, and the problems get bigger, not smaller. But
yeah, absolutely. Now, for anybody who doesn't know Resonance, are there any stats that you can throw out there just so that they can understand the size of what's been going on and what you've been involved with?
Yeah, so I mean, Resonance is, we feel big, and as big as we've been, and we currently manage about 350 million of other people's money in the UK as a UK-based social impact investor. So we feel as big as we've been. Is the biggest assets under management we've ever had. That is obviously pretty small in the big world of capital markets. It's important to think, 330 million of that is made up of property funds. So we have for a long time been invested in property. We buy properties and we manage those properties for charity and housing partners to put vulnerable people into those houses. These are not levered funds. These are not particularly, in some ways I like to say, they're not very sexy funds in a sense. They're just very simple. It all began with St Mungo's, the homeless charity, saying to our now CIO, we just don't have landlords that are ethical enough to keep the people we need that are vulnerable in homes for long enough. So the sort of logic was, well, could we find a way that we buy them and we lease them to you? You find and know the people, the vulnerabilities and the beneficiaries. We do the simple bit of owning, renovating and handing over on sensible leases with an ethical landlord behind it to you. And that's how it began. And so the vast majority of Resonance's funds under management are property funds. We have now got a number of different areas of focus, from homelessness, women in supported homes for vulnerable women, people who've suffered domestic violence, and we have disability funds as well. So that will continue. We'll continue to scale the different specialisms in providing homes. But the key thing that we have always said is that it takes more than just a roof over someone's head to solve for a lot of these problems and to create pathways out of being in vulnerable situations. So that's where the other work we do around investing in social enterprises. We also invest into community assets. That's housing, leisure, sports, and energy. Those two areas, so just bouncing around a bit here, but growing enterprise funds, community asset funds makes up another 25 million of the funds under management that Resonance has. So we are small, and we will, our growing enterprise over the next 5 years, we'll have a fresh set of £10 million to invest over the next 5 years. We feel we can do a lot with relatively small amounts of money, and we continue to focus on regions rather than just the whole UK. So Resonance can invest into property through property funds at scale, social enterprises at sort of community, local, regional scale, and community assets, again, nationally. But again, the community assets piece is a whole other story, but it's really fascinating. It's really about letting the wealth generation be owned by the communities rather than this kind of investor comes in and provides the capital, a thing's achieved, and then the money comes out again.
I guess the phrase democratization might be used a little bit there, right? Yeah,
definitely. And that's a really key part of that particular part of the business. And I think that's, in some senses, thinking about that bigger picture of what are we trying to solve for, it's actually really fascinating and really important. The idea that actually this isn't all about an investor return, it's actually about a wealth creation within a community and an ownership of the outcomes and an ownership of the impact of the change.
No, I first came across you guys through the Academic Health Science Network, and it was all about the Health and Wellbeing Fund.
Yeah.
And I'm trying to remember the exact number, but I think when Will introduced the topic, he said it's something like 25 or 30 companies that you guys have invested in through that Health and Wellbeing Fund. And I looked at him with this quizzical face. I just couldn't compute, because it was probably at that time the highest deployment of capital in the Southwest in terms of even the Cornwall Isles City Fund hadn't done like 25, 30 investments at that point. So, you say it's a small amount of money, but it's doing a lot of good, right? It's getting in a lot of places.
Yeah, and the Health and Wellbeing Challenge Fund, I'm proud to say, is more like 50 deployments now as of finishing just before Christmas. And that's with a health and wellbeing focus, and only in the Southwest. So I think, and that's 5 million in total has gone into just over 50 enterprises, which is fantastic. And as you say, when you think about how starved of capital certainly Cornwall and Devon would be, in the southwest probably to some extent, that's a huge amount. And we're, the the pathway of those enterprises as well is fascinating, because we're also, I guess it's fair to say, as an investor, we're not particularly interested in picking winners over losers and having a kind of 10x return in one place and accepting 40% to 60% go elsewhere. We are actually trying to sustain those companies, often through a journey towards commerciality, let alone picking the best. So the vision is that actually, as many as we can possibly muster of our portfolio will not just, it's not about considering great investments, great returns, but they will go on to have commercially viable, sustainable futures, better governance, better financial functions, the ability to borrow and take investment in the next phases of their business, marketing, but a lot of things that you would sort of say, show me that you've done that before I can invest. We kind of say, we'll invest and go with you to get to that point. And that's partly because to some extent the level of maturity of the social enterprise sector in the UK, and until the growth fund came around, which is where we got some of the money for the Health Wellbeing Challenge Fund, 2015, the market in a sense didn't exist. So we've been building the social investment into social enterprise market for nearly a decade. And there's work to do, but it's a journey of kind of making the market as well as kind of finding the right bits of the market to invest in.
Fantastic. Well, thank you so much for your time today. I want to just close out today with just one question for you, which is, for the first time founders watching this today, thinking about coming up with money, what's your one piece of advice for them?
Show us the passion that sits behind the impact that your business drives, and the authentic connection to it. And I think I would even, obviously we talk to social enterprises and there's certain gateways to become, to think of yourself as a social enterprise. But I actually think for all founders, my understanding is that largely it's about solving a problem, and those problems are often problems experienced by, people, buyers. So I think it's just show the passion for the connection to the impact of the business. And in that context, everybody is either a social or an environmental entrepreneur.
Fantastic. Thank you very much for being part of this series. It's wonderful to have this resonance lens next to VC lenses, next to angel investors and stuff. And I think it's incredibly powerful, and more power to everything you guys are doing, particularly in the Southwest, which is where I tend to see what you're involved with. Thanks for being here today, Ollie.
Wow, thank you for having me. It's a real pleasure. Great to see you.